In this video, we're going to be discussing the differences between a traditional IRA and a Roth IRA. We're also going to be discussing the differences between the terms tax deferred and tax advantaged. Two very important terms to know. This is your future we're talking about, people. So let's get into it. We're going to compare traditional IRAs and Roth IRAs. These are both pretty important aspects of retirement planning. Obviously, you can go really deep into this stuff, into IRAs. If you own your own business, there are some other things you can do. So we're just going to keep this really general. We're just going to keep this between comparing traditional IRA and Roth IRA. And in future videos, we can actually get into more details with self-employed people and whatnot. So first, let's talk about what tax deferred means. So tax deferred means that you don't pay taxes now, and then time goes by and you pay taxes later. So we're deferring our tax liability from now until later. So we're kind of pushing our tax liability down the road and not really worrying about it right now because we want to save money right now. We want to save taxes right now. So we use tax deferred accounts to accomplish this. And there are multiple different types of tax deferred accounts. But for the sake of this video, we're just going to talk about the traditional IRA. Tax advantaged is quite different. Tax advantaged means you pay taxes now on your money, and then your post-tax money, you wait, and then later your gains are going to be tax-free. So you're paying taxes now in order to not pay taxes later. So this is a very, very important way to diversify your tax burden. Using tax deferred and tax advantaged accounts in combination with each other, it can be a great strategy for the long run. But they each have their advantages and disadvantages, and we're going to talk about which IRA is what. So a traditional IRA is tax deferred. A traditional IRA is where you take your hard-earned money and you put it into a traditional IRA, and you basically, whatever contribution you make to that traditional IRA, that amount gets taken off of your gross income. So you immediately save taxes on that money because you're not paying taxes on it now. You're deferring your tax burden until you're basically into retirement, and that money's growing, and you don't have to worry about paying taxes until it's distributed to you whenever you get to retirement age. So traditional IRAs are tax deferred. Roth IRAs are the complete opposite. Roth IRAs are funded with post-tax money. So you've already paid Uncle Sam his money for your income, and you take that money after taxes and you put it into a Roth IRA, and whatever gains you have, whatever capital gains you have on that money, so you invest it and it grows, and you've been getting paid dividends and the market appreciated, and whatever the case may be, you have profit at the end of when you get to retirement. Well, you can pull that money out without paying taxes on it, federal income taxes on it. So that's a tax advantaged account. You sacrifice and pay taxes now, but later in life, you don't have to pay taxes on the withdrawals. So these are very, very important tools for tax diversification. For later down the road, have a little bit of both. That's a strategy to use both of them. But for now, let's talk about what features are, what a traditional IRA is, what the features are of it. Well, we already covered that a traditional IRA is a tax deferred account. So we are not paying taxes on our contribution right away, and save taxes now if you qualify for your tax deduction. So little caveat here, there's something that you need to understand with traditional IRAs. Depending on if you participate in a 401k or a qualified plan at work or not, could determine, and then combine that with how much money you make, it could determine if you can actually deduct the contribution or not. So I kind of wanted to clear that up. So if nobody in your household is participating in any type of qualified plan at work, no 401k at work, no IRA at work, or whatever it is, there's no limit. You can make a bunch of money and you can deduct the full amount of your IRA contribution up to the max limit. So the max limit you can contribute to a traditional IRA is $6,000 for 2019. Depending on your activity or your participation in your work plans, and then if you're single or married filing jointly, determines if you're going to be limited on either a partial contribution deduction from your taxes, or you won't be able to deduct any of it at all. So you can still contribute to it up to the limits, you just won't be able to deduct that money off of your taxes. So that's something to talk to a tax accountant about. If you are close to those limits, you need to talk to your tax accountant and be like, hey, how much can I contribute and actually deduct off of my income? And they will do the calculations and let you know. So that is side note on IRA deducting, if you're able to actually deduct your contribution to your traditional IRA. And the reason that they do that is because you're already contributing to a qualified plan at work. So you're getting tax savings there. So, they got to manage it. Your max contribution to your traditional IRA for 2019 is going to be $6,000. Now, something to keep in mind here is your max contribution of $6,000 is actually between both your Roth and traditional. So basically the IRS is saying, hey, you can take $6,000, you can divvy it up how you want. If you want to put some into a traditional and some into a Roth, that's fine, but you're capped between both accounts up to $6,000. So you can't put $6,000 in a traditional IRA and $6,000 in a Roth IRA. You have to decide how you want to divvy it up. If you want to divvy it up at all, maybe go all in on one. Who knows? That's up to you. But that is something very important to keep in mind. Okay, so once the money is in your traditional IRA, you can invest it. You can invest it into stocks, bonds, CDs, whatever offerings there are at the brokerage that you choose to open your traditional IRA with. That could be Fidelity, Charles Schwab, TD Ameritrade. There's endless choices for you when it comes to these accounts. So what happens is you put the money in, you get your tax deduction if you qualify, and you pull the money out in retirement, and you have to be at least 59 and a half minimum age to withdraw the money without any penalty. So if you take the money out early, you are going to have to pay income tax and a 10% penalty if you take money out before that date comes. Once it's in there, you want it to stay in there. You want it to stay invested because, staying invested over the long term is what develops wealth. That's what creates wealth, is the longevity of compounding interest over so many years, and it just grows and grows. So you want to keep the money in there if you can. I know things happen, something to keep in mind. When you retire and you're at 59 and a half, you can take your money and take withdrawals from your IRA. And then when you do take those withdrawals, you have to pay taxes on them. That is a traditional IRA. Now, let's talk about Roths. I think Roths are great. I think tax advantaged accounts are awesome tools that everybody, if you qualify for, it's something great to have in your arsenal for your financial planning, for your future. So let's get into exactly the differences between the Roths and the traditional. So Roth, as we discussed earlier, it is a tax-advantaged account. So earnings are tax-free in retirement, and you fund it with post-tax money. Now, there are income limits to be able to contribute to a Roth IRA, unfortunately. Now, before you get to that point where you can't contribute at all, there's actually a phase-out limit. So talk to your accountant. You might be able to contribute something to a Roth IRA if you make between a certain amount before you get to that, max limit. In this case, 137,000 filing single, head of household, and then 203,000 filing jointly married. So there is a window that you could still contribute something. So you'll have to work with your accountant to figure that exact amount out. And so that is the limitation with a Roth IRA. There are some income limitations to being able to contribute. So I already covered this. The max contribution is $6,000 for 2019's IRS limits between both your traditional and your Roth IRA. So you can split it up, diversify your tax savings, and then you can also, with a Roth IRA, do the same thing. You can invest your money in stocks, bonds, CDs, whatever offerings the brokerage has for you. And again, you can find these accounts at Fidelity. You can find them at Charles Schwab, TD Ameritrade. For the most part, most brokerages offer these types of accounts. That's it. So main differences are tax advantage versus tax deferred, and main differences are there might be income limitations to how much you can deduct in a traditional IRA, and there might be limitations to even being able to contribute to a Roth at all, depending on how much you make. But if you do if you fall within the ability to be able to contribute to a Roth IRA, it's really a good idea to look into, because we don't know what tax rates are going to be in the future, right? So if you're 30 and you aren't retiring for another 30 years or so, we don't know what things are going to look like then. So that's why tax diversification is something that a lot of people utilize in their strategies, because we don't know. Maybe the tax rates will be lower, maybe they'll be higher. And this is a way to just make sure that we are diversifying and utilizing multiple strategies to be able to fund our retirement and have security in the long run.